Happy Friday, friends. It's Shayan with Integrity Home Mortgage back with your rates rundown for May 15th, 2026. This has been a dense week with news and events relevant to fixed income markets. We had a hot consumer prices print, an even hotter producer prices surprise, and the Senate confirmed a new Fed chair, and of course, a bubbling geopolitical backdrop that seems no closer to resolution. Let's start by having a look at our benchmarks because after several weeks of bouncing around wildly, but within a fairly defined range, we're breaking out of that range today, and it's not for the better. Since last Friday, 10-year Treasury yields are up nearly 24 basis points to 4.6%, and the 30-year fixed mortgage rate is worse by 28 basis points, up just over 6.75%. This is the highest Treasury yields have been in a year, and the worst mortgage rates we've seen since July. This is because, as I mentioned earlier, two consecutive hotter than expected inflation measures this week, which has shifted the market narrative in a meaningful way. Consumer price index rose 0.6% in April and 3.8% year over year, accelerating from 3.3% in March. And now we're looking at our highest annual reading since May of 2023. You might be tempted to chalk all this up to just increased energy prices, but even core CPI, which excludes volatile food and energy impacts, accelerated on both a month over month and year over year basis from where we were in March. Notably, the market didn't react much to that. That is until we got producer prices. The results came in on Wednesday and they blew away expectations. April's PPI reading came in at 1.4% month over month versus a consensus forecast of only about a 0.5%. Now, this increase was largely due to energy costs, but it also showed an increase in the cost of services, which is perhaps an indication that tariff costs are starting to impact on a more broader scale than just goods. Also, a notable event this week was that the Senate confirmed Kevin Warsh as the new Fed chair. So that means today's Jay Powell's last official day in that seat. Uh, Kevin Warsh has been a vocal proponent of a lower policy rate, but with inflation currently sitting at its highest point in 3 years, no one believes he's actually looking to get back into the cutting game anytime real soon. In fact, not only has the probability of rate cuts in 2026 evaporated to zero, but futures markets now place a rate hike at higher odds than a rate cut this year. And a rate hike is actually at higher odds than even a continuation of the pause in 2027. So while markets had been ignoring data in favor of oil prices since the beginning of the Iran war, the inflation picture, I guess, at this point has gotten to such a stark point that that investors feel like they can ignore it no longer. At least until things between the US and Iran get either better or worse, that is. And when it comes to inflation, you'll hear a lot of talk about price shocks versus sustained inflation. For consumers, both things suck because they both result in higher prices. And last time I checked, we pay prices, we don't pay inflation. But for policymakers, they kind of look past price shocks because the presumption there is that inflation will normalize once the shock subsides. For sustained inflation, though, generally that's something that requires some action on their part. But even then, we need to acknowledge that not all sources of inflation can be equally impacted by monetary policy. And this is especially true when it comes to sustained inflation focused in areas where demand is inelastic, like food and energy. And that's exactly where the supply chain disruptions from the Strait of Hormuz are concentrated. So the longer we maintain this current situation, the stickier inflation becomes, and the more likely it becomes that price shocks progress into sustained inflation. But no amount of rate hiking alone will get boats full of oil and fertilizer moving again. Until we see some movement on that end, I expect rates will remain under pressure over the near term at least. Geopolitical headlines will continue to garner market reaction, but the more head fakes on peace talks and ceasefires we see, the less optimistic those reactions will become. And this has been a rough day. So I wanted to end on a positive note. And that is to recognize that while we may wish that we had the rates from 3 months ago, mortgage rates are actually still historically pretty good. To put it in perspective, when treasury yields were hanging around 4.6% in late 2023, mortgage rates were a full percentage point worse than they are right now. So we're talking the upper sevens, low eights. So while there's not a whole lot about today's market that you might look at and consider normal, mortgage rates actually are. That's all I got for you this week, folks. Have a great weekend, and we'll see you next time.